If we do, then if you look at that range, as you can see, the range is approximately close 15 to 20 points. As a pure technician, if it breaks out, it's going to go up from the breakout about 15 or 20 points, which is 150 to 200 points on gold futures. So from 315, the projection is, I would say, about 330, 335. I'm looking at what I'm going to buy, and I'm going to do it this morning. Although it's up a little bit, I don't like chasing, but it's still in the range, so it's fine. I'm looking at November, monthly November, 315 calls. 315s they're trading at about $10. It's going to be maybe a little bit higher because we're going to open higher. You don't have to chase it and buy it this morning. You can wait for a pullback, or I think that would be, it gives us about 3 months, a little over 3 months, which is sufficient. And if you buy it for, let's say, $10 to $11, something in that range, I believe it'll double.
Well, no. Okay. So when are you looking to take a profit? Is when you double? Is that correct?
I, yeah, yeah. It depends on if everything works out the way I think it would. Um, I would say that we'll go to around 330 and look at the charts and see when it gets overbought or done. Then you can either sell it or maybe um, sell a higher call um, against it to hedge it. On this chart that you can see, if you look at the bottom, that blue line, that's implied volatility. Implied volatility on commodities, and especially gold, works the opposite of implied volatility on stocks and S&P 500. In S&P or stocks in general, volatility is negatively correlated to the move. So stock market goes up, volatility usually lower because options become more expensive when we're in the bear markets or corrections, things of that nature. In case of gold, the volatility does the exact opposite. It goes up when the commodity goes up. And this blue line on the bottom of the chart, if you can see it, it is a good illustration for it. If you can see, like in April, when we made new highs, when we went straight up,
Yeah.
see how volatility went up to like 25, 26, which is very high for gold. Right now, we're sitting at about 15, 16, which is normal. It's kind of actually, I would say, on the cheaper side. The options are not that expensive. So if you pay, say, $11 for this particular option, you don't have to buy this option. That's exactly what I'm going to buy. But it depends on your risk tolerance and appetite and so on. I think they're relatively cheap. And if the
Got it.
market is going to go, and market, I mean, if gold goes up, volatility is going to go up. So we're not just making money because we're right on the direction. Hopefully we are, but also volatility will help us as well. And if it goes up, and if you see maybe a short-term overbought condition, you can sell something against it. Let's say you buy 315, it goes up, it breaks out, gets a little overbought. You can either take profit, or let's say you sell like 335, 340, 345 call against it, which is going to be very expensive. So the volatility of this particular option at the moment is about 15, but the volatility of 335 option is higher. It's trading at about 70. But right now,
Got it.
we just do simple thing, nothing too sophisticated. Just buy a call. My choice is 315 November.
Got it. So you're right out of the money. Correct me if I'm wrong. And we're looking at a 3 to 4 months out time period.
Exactly. Yeah, exactly. I think it's worth the risk. I think
Got it.
it's a simple trade. Again, not a certainty, a probability, but allocate a little bit of capital to this. And like in case of our portfolio, I'm going to allocate 1%. So something
Got it.
more risk immersive.
Got it. So just to give all my listeners and viewers a little bit of background, Dennis was my partner in a hedge fund that we had several years ago. when we were running on some money, and he is my partner in portfolio now in our managed accounts in our fund. So yeah, this looks excellent, Dennis. Can you and to all my viewers and listeners, Dennis really is not only an excellent portfolio manager and technician, he has he trades a lot of options, if you would, options to not only to speculate and invest, if you would, but also to hedge. Um, I really like the idea of selling a higher premium call. If you would, the higher we go. It's almost like, correct me if I'm wrong, it's almost like you're getting the premium of the call that you're selling above that. We're collecting that, but we're also getting the upside, capturing most of that upside move, correct?
Exactly. Exactly. So there's always nothing wrong with selling something. Well, if you own them, never sell naked options. As we say, never sell naked options.
Unless you want to own the asset.
Yeah, yeah, in case of puts, that's right. Or calls unless you want to be short. In this case, we want to be long. So we'll start the position as buying a simple call. And if we're correct, let's start with this. If we're wrong, you know exactly how much money you're going to lose. Let's say we're
Right.
wrong, gold doesn't go anywhere or goes down. Let's say you buy it for 11, which is $1,100. You know exactly that you're going to lose this amount. So,
Got it.
gold crashes. Okay, I lost 1,000.
Right.
Okay, fine. If it goes up, then it might require a little bit of management. Either you just hold it and say, all right, it's going to 330, 335, like we kind of like we were expecting. Fine, it's going to go there. It'll double roughly, or maybe more. But if it starts going up a little bit too fast, you sell something against it. That's going to be like a free position. So
Yeah. Excellent. Explain to me a little bit more about the volatility. I just for all of our listeners, I understand that, but I think that's, for all of those that don't, I think that's a great indicator. It's a contrarian indicator. Is that correct?
that's right. The volatility, just like most traders watch VIX, right? That's a great indicator and a good predictor of market movements when it comes to S&P 500 and overall market. The same thing with gold. In this particular chart, it's GLD. So it does the exact opposite of VIX. So when gold goes up, volatility usually goes up with it. But when it goes down, the declines in gold, they're kind of subdued most of the time. People abandon the market and the volatility goes down. Therefore, market makers starting to price options lower and lower because there's less participation and they prefer to own it rather than give it to the traders, to the fee. So in
Yeah.
this it's in this chart on the bottom, you see the blue line. It's a very good illustration.
Beautiful picture.
Yeah. So you see the blue line is correlated to the price on top of the chart.
Yeah, that is an excellent indicator. And Dennis, just for all my viewers and listeners, Dennis and I have done this many times in the past, and it's, to my knowledge, it's mostly, not always, but it's mostly been right. So I love,
That's right.
that's why we trade it. Dennis, what other indicators, specifically to this, but in general, do you like to look at for the technicals?
Well, the number of them, starting from classic chart patterns, they help. They they never are a guarantee, but this one is such a classic one where you got a quadruple top and sort of like a, call it a triangle, a bullish triangle that in majority of cases resolve to the upside. So the trend ended in April. The easy money ended in April. We got very overbought. Volatility was very high. Okay, we got overbought. I don't have other indicators here, but if you were to look at RSIs, MACDs, the classic ones, the conventional ones, they were really overbought. And you and I were thinking 3, 4 months ago, well, at some point, we still bullish gold. We still like the commodity, but everything has time. And when it gets a little overdone, people take profits. It's natural. And those indicators, our oscillators, they help us to say, all right, this is a little bit too much. That's what happened in April and what's been happening since April to now is just a consolidation. It's a consolidation. It's just a range type of trading. People got out, some people are getting in, and the pattern, just the pattern itself, confirms that this is not the end of the bull market. It's just a pause, which lasted about 3 to 4 months. Might last another month. Well, I'm not saying that we're going to break out today,
Right.
but it's just a pause, a refresh, and then we have another leg up. That is my bet. So that's
Yeah.
exactly what I'm going to do when markets open.